As I said, my name is Ridgway, Barrister, Temple Tax Chambers. I'm talking today, it was billed as current tax issues. I've decided to focus on directors' loan accounts, overdrawn directors' loan accounts, and the write-off, release, setting off, etc. in a liquidation, both members voluntary liquidation and compulsory and CVAs. Now, along the way in my career, I did do the JIEB exams, and when I say I did them, I did actually pass them as well. So I do have a background in insolvency, and I also was a pupil at for a guy called Gabriel Moss, the late great Gabriel Moss, which is where I got my sort of interest in insolvency from in the beginning. Now, as I say, today I'm talking about directors' loan accounts. Now, they've recently come to the fore because HMRC have published various things recently about how they're intending to deal with directors' loan accounts in the future and that sort of thing. I'm going to come on to those slides at the very end. Now, many people will have dealt with directors' loan accounts and do things in a certain way and have never had any trouble with them. Now, the thing I say to that is that is fine, except if you do something wrong, often it isn't noticed. I'm not suggesting that you do it deliberately wrong or negligent or whatever. It's just in the cut and thrust of dealing with people. But a bit of my practice, unfortunately, is trying to sort things out after people have got things wrong. And today, what I'm hoping to do is try and help you not get it wrong in the first place. Now, tax is a complex subject. Insolvency is a complex subject. Putting them two together can make it even more difficult. But hopefully today we won't make it too difficult. Now, yes, animated slides. I'd forgotten about that. We're starting off with a sort of loans to participators in general. Now, when we deal with family companies, sorry, my dog has just decided for the first time ever to bark. When we deal with family companies, most of them will be closed companies. A closed company is a company which is under the control of 5 or fewer participators, which are shareholders or loan creditors, or under the control of its directors. So generally, most family companies are closed companies. Now, when a closed company makes a loan to a director, it will result in the company becoming liable to pay an amount of corporation tax equal to what's called the dividend upper rate for the tax year in which the loan or advance is made. And that's Section 455 of the Corporation Taxes Act, CTA 2010. Now, the amount is payable on the day following the end of the period, 9 months from the end of the accounting period on which the loan or advance is made. So that's quite a lead time. And it's payable on the day that the corporation tax is generally payable by a company. Sorry. So there are anti-avoidance provisions which stop you repaying the loan immediately before the 455 tax is payable and then re-advancing it a couple of days later. These are called bed and breakfasting provisions. But for most people, the payment of the 455 tax is meant to be a sort of disincentive because it's the amount of tax you would pay on a dividend of that amount if you hadn't made the loan and paid a dividend instead. Having said that, as we're all well aware, during insolvency processes, we often find directors with very large loan accounts, often taken out in a couple of years prior to the insolvency. Often, again, they've not actually paid the Section 455 amount, which I'll come on to in a few minutes' time. But generally, the situation is that the loan is made to the director, the company pays an amount to the revenue. If the loan is repaid or released, then that amount is paid back to the company. So in a sense, it's an asset of the company if it's being paid at the time that the company goes into liquidation, if there is a director's loan account. Now, if the loan is subsequently released or written off, the director is liable to income tax on the amount of the debt which has been released. and it's taxable in the year in which it is released. Now, there are a couple of provisions here which people don't often deal with. Once a director has got a loan, not only is it a loan to the director, if it's income tax, if it's interest free, then what happens is that they've got a beneficial loan. So they should be reporting on their tax return an amount of a benefit equal to effectively the tax on the interest which is foregone, and the tax is the interest, sorry, is at the official rate. So there should be some clues as to the fact that the director has a director's loan account by their income tax returns having returned this sort of notional benefit in kind. Having said that, often because of the shambolic way in which some of these companies are run, that amount has not been declared. So that's something that you might want to take up with the director in the future. Sorry. So the basic position in liquidation is where a repayment is made or the loan is written off, the company goes into liquidation first and an accounting period ends. Now, it should be noted here that an accounting period ends and then an accounting period ends 1 year after a year, each succeeding year. It cannot end by any other means unless the company is dissolved or wound up. Dissolved or struck off. Now, the reason I mentioned that is that I've talked at a number of conferences where people have asked questions afterwards and said, well, we're in members' voluntary liquidation. The director's loan account has effectively been wiped out by us setting off the loan against the capital which the director was entitled to in the MVL. So we've given them a net amount. Now, the set off of the loan, as I'll mention later on, is treated as a payment of the loan. So the 455 amount is repayable. However, the 455 amount is repayable 9 months after the end of the accounting period in which it's repaid or released. So at the time that you set it off against the capital which is owed back to the director, you still have to wait till the end of the accounting period and then another 9 months and 1 day to get the money back. And the question is there any way of advancing that? Now, as I say, I've spoken at a number of conferences where people have said afterwards, well, they've had negotiations with the revenue, and the revenue have said, well, if you shorten the accounting period, obviously we can pay you back that much quicker by the time that the accounting period has been shortened. However, as I say, the law is that in a liquidation, the accounting period doesn't end otherwise than the expiration of a year. So if the revenue are suggesting that, obviously get it in writing, get it sorted out. But in law, it's not a possibility. So I just mentioned that because, as I say, some people seem to have been doing deals. If you can and you get your money back and you wind it up, no one's going to object. But as I just say, that the accounting period doesn't end otherwise than the expiration of a year. So where the loan is not repaid or written off, let's just do this. Sorry, I'm just right. Where the loan is not repaid or written off, but as I say, the company goes into liquidation and the accounting period is end. The shareholders are entitled to a proportionate share of the assets and the winding up, obviously, and that will include the receivable represented by the overdrawn director's loan account. Now, there are potential issues here, and I've seen the revenue take issue. And as I say, it's not every time that they do this, but sometimes an inspector or an officer of HMRC will get a little bee in their bonnet, open an inquiry, and then start to ask some questions, often without the knowledge themselves as to what the answers are. So one of the ways that it can be done is that the loan can be assigned to the shareholder and extinguished because so the director, let's say the director is owed £1 million in the members' voluntary liquidation and owes £500,000 to the company. So the liquidator assigns the £500 receivable to the director, so therefore they're entitled to £500,000 of capital, and the rest comes out as and when it is distributed. So the loan is assigned to the shareholder and extinguished. The assignment satisfies the rights of the shareholder in liquidation, and the shares which the shareholder have are disposed of as capital asset, and they will make either a gain or loss depending upon exactly what the base cost of the shares was when they subscribed originally. Now, as I say in the slide, the legislation is quite clear. The distribution of assets and winding up is not a distribution within the income tax definition. It's a transfer of assets and liabilities between a company, and therefore it's treated as a capital distribution. However, one of the questions which has been raised in certain inquiries is, if you assign the loan to the director when you're in liquidation, has the loan been repaid or written off? Because what you've done is assigned it to a director, and because they owe themselves, it's extinguished. So is that a repayment, a writing off, or is it something else, a third thing, an extinguishment? And if it's an extinguishment, then is the 455 tax repayable? Because the legislation says it's repayable if the loan is repaid or written off. So one of the arguments that the revenue have raised is that you don't get the section 455 tax because you've assigned the debt. Now, obviously the easy way to do that is, as I'll mention later on, is to effectively set the debt off against the capital amount repayable, because set off is treated as mutual payment. So if you do it that way, the question never arises. If you do it the other way, potentially to ask questions. And I genuinely think it's a difficult question to ask. I mean, what you'd say is that there was a loan to start with, it's not there anymore. So if it's not there anymore, has either been repaid or written off. That must be the thing. And as I say, it's not been written off in the books of the company because they've effectively assigned it to someone. It must have been repaid, and therefore you're okay. But you can waste valuable time, costs, and all sorts of things arguing those types of things with the revenue. So as I say, I suggest ultimately that the idea would be to set off. So I've asked the question there, what happens to the section 455 tax? The very final bullet point there at the bottom is subject ultimately to section 369B of ITOIA 2005. Now, section 369B is an anti-avoidance provision. It applies where a company goes into members' voluntary liquidation, and then effectively the person who was running the company sets up another business which is identical. This is to stop anti-phoenixism. This is anti-phoenixism, where basically you keep setting up a company, building up a capital sum, liquidating it, taking the money out for capital gains tax, getting possibly business asset disposal relief, and then setting up a new company and doing the same thing again. What section 369B says is that if you do something within 2 years that is the same or similar, any distribution that you got which was chargeable to capital gains tax can be reclassified as income, as if you'd taken it out as a dividend. So it's an anti-avoidance provision. It was introduced, I think, in 2019. But I just mentioned that because a number of directors often think they're being very clever. I see some firms advertising that you get business asset disposal relief and it's all very good, and then the director just goes off and does the same thing again and gets hammered just a little bit later. So what I'm going to do now is just deal with first of all, the position in members' voluntary liquidations. I've already touched upon this a little bit. The revenue happily note there are solvent liquidations. I say that because there's often some confusion in the revenue manuals. This is taken from one of the revenue manuals. At the time that shareholders owed the company amount to the overdrawn loan accounts, the shareholders could repay the overdrawn loan account and then would be entitled to receive the full amount of value of the net assets as a capital distribution. So you can repay and then get the net assets back. And as it says there, if the loan is repaid, the section 455 amount is repaid by HMRC. Now, one of the problems is liquidity. And so what you could do, if the director has some money he can pay the company part of his director's loan account. The liquidator can then make a distribution in cash, which he can then use to repay more of his director's loan account, which can then be repaid in cash as a distribution, and it goes around in circle. Eventually you pay the loan off, which is effectively like setting it off. But I've seen that happen a few times. Otherwise, they can set off the value of the assets due to them against the debt. So the liquidator says, I owe you £1 million as shareholder, you owe me £500,000. The way I used to do this when I was at Deloitte and ran the members voluntary liquidation group was to basically issue what we called a distribution warrant, which said that we owe you this amount, you owe us that amount, could you kindly sign that you're happy to set the two amounts off and we will distribute the net balance. Now the point here, of course, is that if you do this and you set it off, then set off is mutual payment. What you don't want to do is mutually agree to release the amounts. And in fact and practice, the things are the same. But in law, if you set them off, it's payment. If you release, it's not. And 455 says that if you release a debt, then you get a different result from if you pay the debt. So you release the debt, the 455 amount is repayable, but of course the director has now released a director's loan account, or had a director's loan account released to them. In theory, they could be taxable on it. So as I say, we set it off, we don't release them. So there's no question of Section 415 income tax being payable if you deal with the loans in these ways. But as I've said, there is timing issue because the tax which is repayable that you've paid under Section 455 is payable 9 months after the end of the accounting period. So if you go in to a company and members voluntary liquidation, in the first month, you sort everything out and you deal with the director's loan account such that the 455 amount is repayable, because an accounting period will not end for another 11 months, you've actually got 20 months before you can get repayment of the 455 amount, which in theory, well, I say in theory, which means you've got to hold the liquidation open just purely to get some money back. Now, the revenue do allow, and in law you can do it, allow the assignment of a receivable. You have to get in touch with them and deal with it. So one of the ways that you could deal with that is work out what the net sum of the 455 amount is that's coming back, and assign it in the liquidation, making sure you inform the revenue, etc. So that might be a way of actually winding it up quicker than would otherwise be the case. So as I say, you can assign a receivable from the revenue, but it's best to get all the formalities right. When you do it, contact the revenue, say what you're doing and how you're going to do it. So this is an example. Sorry, I've got so many clickers here. So this is an example that the revenue give in their manuals. Basically, participant owed the company $1,425,000. The company went into MVL in June 2017. Net assets total $5,300,000. On June 1st, declared an interim distribution to liquidation of $1,425,000 per ordinary share, giving a total distribution of that of $1,425,000. Not paid out to cash, but the shareholder, but was credited to his loan account. It would be a capital distribution within 122. This is not a release of the loan; it is a repayment of the loan, and therefore there can be no charge to Section 415. Now, this is interesting because this was changed after I'd had a discussion with them some time ago, because there was something in the press. Someone started a hair running saying that the revenue was starting to tax payments in an MVL to Section 415. They weren't, or income tax under 415. They weren't, and they changed this. What was actually happening is people were releasing loans in creditors' voluntary liquidations, and the directors were being taxed, which is perfectly correct. So again, the revenue note that the liquidator should seek repayment of any loans, or if repayment is not made, should release or write off any outstanding loans. Where the whole or part of the loan is written off, Section 458 relief will be due and any 455 tax will be repaid. Now, when the whole of the part of the loan is written off, there should be a charge under Section 415, which is the income tax charge on the person to whom the loan was made, and also Class 1 national insurance contributions, if there were an employee as well, or a director. So if the remuneration is profit derived from an employment, then the NIC, and that was the case there of Stuart Fraser Limited and HMRC. I've given the Bailey reference there on the slides. If you copy that into your browser, the case will come up in Bailey. Now, there's a recent case, and I mentioned this, very conscious of the fact that this is the Scottish Institute, and that's because the case is called England and HMRC. Now, the case of England and HMRC, the shareholders had the directors had basically taken loans from the company of about £1 million. They couldn't afford to repay it. So they entered into an agreement where they would repay £100,000 in instalments, and having paid the £100,000, effectively the balance of £900,000 would be released. And the question was, when was the release made? And I think that the case was wrongly decided. The judge decided that the release was made when the agreement was entered into. But what happened was that they repaid the payments over 2 years, and they gave security for the £900,000 in the event that they didn't pay the instalments on time. Now, if you think about it, what that is a conditional agreement that we will release the debt conditional upon you paying the £100,000 over 2 years. And theoretically, the debt must still have been there, because otherwise, why would you give security for it if it had been written off? But as I say, the tribunal held it was written off in year 1, and it was a timing issue as to in what year does the write-off happen. As I say, I think it was wrongly decided, but I think what behind it for the revenue, you say, well, why would they argue 1 year rather than the next? Because surely they'd get their tax either way, 1 year or the following year. But I think in the background, what had happened is they'd assessed in the first year through a discovery assessment, and they'd not opened an inquiry into the following year. So if the release happened in the following year, then they hadn't made an assessment and they couldn't get it. Because it would have been out of time, whereas in the year that they did. So as I say, I think that's partly the background to it. But I do think it was wrong, and I'm hoping it goes to appeal, but there might not be sufficient money in it. As an aside, I had a case a few years ago where the directors had taken very large sums out, and they were negotiating having a write-off and etc. And the liquidator turned around to them, and they got a bit fed up with the negotiations because the shareholders were as I say, were being really quite sharp and prolonging things and whatever. So the liquidator just turned around to the shareholders and said, okay, it's quite easy. What we're going to do, because there's a large sum of 455 tax repayable to us, you can have the money. We're going to release the entire lot to you. We're going to get the 455 back, and we're going to tell the revenue that you've just got a couple of £1 million in income, and you've got national insurance contributions and income tax to pay on it. So thank you very much. Go away. So they effectively use the idea of a release as a threat to the directors to get them to play ball on the amounts that might be released, etc. The position in insolvent liquidations is the director's loan account here is 1 million overdrawn at the date of liquidation. The balance of the company's assets, they say, net of the overdrawn DLA is 500,000. The shareholder will be due a distribution chargeable to capital gains tax of the amount of 500,000, which is the net assets. The distribution will pay 500,000 of the overdrawn loan account by set off. Relief under 458, which is the repayment of the 455 tax, will be due. However, it still leaves the shareholder owing £500,000. And so where the liquidator releases or writes off the balance, would be chargeable. The director will be chargeable under Section 415, where the liquidator and participator into a settlement agreement where they pay off full and final settlement. That also amounts to release or write off of the balance. 42. They've given another example there, which I'm going to pass on because you can read through them at leisure. I just want to talk about a couple of other points. Where the loan is irrecoverable, it may be the tax has not been paid under Section 455. And I noticed very quickly in the question box that someone mentioned Crown set-off. So the position in insolvent liquidations, if it's recoverable, it may be the tax has not been paid. Now, the revenue actually say that HMRC will then be a creditor for the Section 455 tax in the liquidation. Obviously, it's an unsecured amount because it's not VAT or PAYE, but the revenue is a creditor for 455, and they can prove for that, should they so wish. But then if the loan is written off, obviously there's probably a set-off because there's a repayment of the 455 against the 455 that was due. Now, someone's mentioned Crown set-off, and this is actually a very difficult area. I've locked horns with the revenue on this on a couple of occasions, but we've never got to litigation. Either the sums have not been large enough, or they've been so large that some sort of settlement has been done. There's been nothing in the middling ground, sort of thing. Now, there's set-off is Crown preference set-off, but also there's insolvency set-off. Now, insolvency set-off, obviously, you take the date of the administration or the liquidation, and you can't set off over that date because you crystallise the debts at that date. Now, there is a provision that was written into the Taxes Act, I think it's Finance Act 2009, which was meant to replicate the set-off provisions in the Insolvency Act. However, it seems to be subtly different. If you look in Hansard, they said that basically they're just doing the same as insolvency set-off. It's just to put it in the tax code. But you sort of say, well, why would you want to do that? Because now you've got two set-off rules, and you've got to try and work out, are they the same or not? Now, the set-off rules in tax say that you can set off, you can't set off anything unless it's to do with something before insolvency. I've not put the words up there, but one of the arguments the revenue run is that the 455 amount, the way that you deal with it to get it back, is actually to make a claim by altering the tax assessment in the year that it was made. Now, if you alter the tax assessment in the year that it's made, arguably it's something that's happening before insolvency. I mean, I think that's wrong because the 455 amount relates to something done after insolvency, which is the release or writing off of the loan or the repayment of the loan. And therefore, it should be repayable as an asset in the liquidation or administration. But the revenue have take issue with that. So I'm not sure I've answered the question, apart from to say that it's very difficult. Certainly, I've advised that the 455 amount should be repayable in a liquidation. As I say, the revenue have occasionally pushed back against that, and basically have we've had to negotiate on it, but it isn't clear. Now, I notice my time is drawing to a close. Just a couple of points to make. It may be that you've got two directors' loan accounts, one that is owing to the company, one is owing by the company. If they are separate accounts in the books of the company, the 455 tax is still due on the one that is overdrawn. If you make book entries to set the two off, so you've only got one director's loan account, then the 455 consequences follow, but it would still be repayable 9 months after the end of the accounting period in which the set-off was made. And as you see there, it says netting will be allowed from the date of book entries. I've mentioned the case next of Collins and Addies. This is a very old case when the law was slightly different. Having said that, the debt was novated, and being novated, it was therefore not repaid. So the technical analysis in the case was that there was no repayment of what is now the Section 455 amount because it wasn't either released or repaid, it was novated. And secondly, that because it had been novated to someone else, there was a new loan and a new Section 455 amount was due to be paid. So that's just a trap for the unwary. Oops. So I've put here issues. This is a case I had a couple of years ago where the loan was to Company B in members voluntary liquidation, and then there was the holding company, Company A. And what the liquidators did was distribute the loan to Company A and then distribute the loan to the shareholders to extinguish it. Now, as you can see, that the company that had the loan written off and extinguished was Company A, but the company that had paid the Section 455 was Company B. Question whether the assignment of the loan to Company A gave a repayment of the 455, probably not. When Company A basically set off the loan against whatever, it was not repaying a loan that had been made to it because it had been made to Company B, and the revenue came charging in. We managed to write them an opinion which basically said this was a tripartite agreement that effectively, in consideration for the directors releasing the loan to the company basically distributed the assets to A, and A distributed the assets to whatever, and therefore there was a release and the money went round in a circle. Eventually, the revenue bought that. I think, you know, on the wording that they put in the agreement, it worked. But if you'd done it another way, I can see the revenue certainly saying the 455 amount wasn't due because technically the wrong person had repaid the loan, and so that can cause problems. So to sum up on that, can the loan be repaid pre-liquidation? So you get it 9 months afterwards. That's what you should be trying to do. If you're going to repay it by set-off. You can possibly circulate cash around the company and pay off the loan in the liquidation if there's a bit of spare cash in the bank account. If there's an assignment of the debt, does that restrict the payment of the 455? Because you might have a problem there. And has the director been advised that the release of the debt will give rise to income tax and NIC liabilities? Now, my final 3 slides, which you may have seen, is insolvency guidance. Now, the revenue have given a special. Craig Dixon is the man to go to, and it's there, and he's even given his email address if you want to discuss the case. Now, what the revenue is saying here is if you are an insolvency practitioner, when you do release the loan, they're basically saying, if you phone us up, you can tell us that you've done this, and we'll tell you what the consequences are, and we'll sort out the 455. And really what they're wanting you to do is dob in the directors. And I know some people have been to the ethical people of their representative body. And the general view is that if you are releasing a loan, you should be telling the revenue about it. And the revenue can then either send them what's called a nudge letter, which sort of says, we think you might have got a bit of money. You know, do you want to tell us about it? And if they don't then respond to the nudge letter, then what the revenue will do will assess them or open an inquiry. And that's how they will deal with it. So those 3 slides, as I say, they are on the R3 website, which is where I obviously copied them from in total breach of copyright. But then again, if you're going to breach copyright, you have to be doing it for financial gain, and I'm not. So the outcome of this is that the revenue are very much now into directors' loan accounts. They understand that there's money to be made from them when in insolvencies, and suddenly there's a greater focus on insolvency, which the revenue never did, because they never thought there was really any money in it. But no, the taxman cometh. So are we doing questions or move to the next section? I mean, I'm happy to take the questions that have been put in the box and possibly answer them, and then you can circulate it amongst members after the event. I think that might be the easiest way to get you on track on time.
We've got a couple of minutes, so
all right. Okay. So
questions.
Do you want to ask them, or shall I try and find them?
Well, we've got 2 that are sort of the same from the same issue, where you've got an insolvent entity, books and records aren't up to date. We do what James Dempster just spoke about the previous session about investigations, bank statements, and you end up with a director's loan balance figure, which may be disputed, may be significant, and then you accept a settlement at a reduced rate, you know, avoiding the lengthy arguments, all the costs, proving the entities, threat of court action, all that stuff. It's just a question, how do HMRC treat that? And I don't know if that's actually linked to the last slide that you put up in terms of what do they know when a large loan balance has been.
The revenue really don't know anything. The real question is that once you've sorted it out, if the director is accepting that yes, there is a loan of that amount, then I think there is a loan of that amount. Now the 455 tax won't probably be in play because the records aren't complete, and they probably were just taking bits of money out now and then, or buying a car with it, or doing something and owing the company some money. But once you've identified an amount which is accepted by both parties, is owable to and from, then if it is released or compromised, I think you have to accept that because it was accepted as due, that there has been a release and it's taxable on the director. Now, if no 455 tax has been paid, I don't think you can, obviously can't claim it back. The revenue would say it's an unsecured claim. You know, the 455 tax is meant to be paid when the loan is made, and obviously it's not difficult. It will be difficult to know when it was made, but what you could say definitely it was probably made. Well, it was made before the company went into liquidation, so it should be an unsecured claim before the liquidation. But as I say, the revenue should be claiming for it as a creditor. To the extent that the loan has been written off, then they should reduce their claim by that amount, because it's no longer due from the company, because it would be repayable, and presumably they will be set off at that point, or the amount that they're claiming would be reduced. But that comes back to the Crown set-off point, that if it's not payable, if it wasn't paid before liquidation, and therefore they're an unsecured creditor, but the loan is written off after, and it would be repaid after, you then say, well, set off, it's unfair because they've got to repay it off, even though an unsecured creditor was never paid in the first place. Now, I'm not sure. I mean, I say I'm not sure how a tribunal would treat that. I'm pretty sure I know how a tribunal would treat that, and they'd find some way. Now, it may be different to whether you go for directions in an insolvency court to say how is it dealt with, or whether you go to a tax tribunal to say whether the amount's repayable and how the assessment's been made. But as I say, that is up in the air at the moment. But with this renewed focus from the revenue on directors' loans, it may be that we do get some guidance, litigation, or whatever in the future.
Yeah, I think that sheet that you put up, it's a voluntary disclosure that IPs can make. Do you have any insight into, are many IPs making disclosures? Is it certain types of cases that are getting disclosed?
I spoke at a conference about 2 weeks ago where I was discussing this with them. And as I say, a couple of them said they'd been to their regulatory body to sort of say, the revenue say it's voluntary, what should we be doing? And they're saying, well, if you're an officer of the court, then, really you should be making this disclosure. If you are independent, then in a sense, there's nothing, when I say nothing to lose, I mean, it is your job to administer the case, and emailing the revenue to say that we've released this debt shouldn't really be a problem. I mean, obviously there are rogues out there who act for directors, and I don't mean the insolvency practitioners, but the unregulated market, etc. else, and that might not be something they would do. But I think that the general feeling is that, notwithstanding it's voluntary, best practice would be to follow it.
Okay, thanks for that.
Thank you.
We will, so thanks very much. That's really interesting. I think maybe there was a couple of questions left, which we'll get you.
As I say, if you send them on to me, we can circulate later. And apologies for the dogs.
We had fire alarms and doorbells earlier, so don't you worry.
Thank you.